So today we'll be discussing about some important standards and its questions. Okay. So we'll revise the standards along with the questions from the past papers. So we know that the overall structure of the exam in such a way that once we start with the group question number 1, the question number 2 will be an ethics question. Okay, your question number 2 will be an ethics questions. So what will get tested in ethics, or how will be the structure of an ethics question? So we'll just look into it. So normally in an ethics question, they will mainly test the accounting issues. Okay, they will mainly test the accounting issues, and we need to check the fact that whether the accountant have done that error intentionally, or is it because of his lack of knowledge, or is it because of some kind of an intimidation threat. Okay, so there will be some accounting issues, and we need to check what went ethically wrong there. So this is a scenario they are going to give in question number 2. Okay, so we'll just have a look into this type of questions. Okay, so in question number 1, they will test you with the group that is already covered. So in question number 2, it is accounting issue with ethics. So that's it for section A. And what about section B? In section B also, question number 3 will test you on accounting standard, specifically on any particular accounting standard. So in past, if you look into those standards is tested in question number 3, it may even start with IAS 38. So it does not include some higher standards. Some basic standards also will get tested in question number 3, including IAS 38. Okay, IAS 38s have got tested. Then apart from that, some higher standards like IFRS 15 and 16 have got tested. So I cannot predict that which type of standard is going to get tested here, but basically you have to cover everything from basics. Okay, and question number 4 will be based on the additional performance measures, that is basically on the knowledge part of interpretation and current issues. So this is how the question will get structured. Okay, so we'll just have a look at question number 2, or ethics type of question, and we'll practice some questions to actually get the idea that how it will get tested and how to draft that answers. Perfect. So take out your kit. Can you see the question here? So here there is an introduction. Apart from that, there is a granting of license, service phase, and the granting of license phase. Okay, so we have to understand the ethical issues as well. Fine. So the first question asks you to discuss whether the revenue from service phase and grant of license to a customer are two separate performance obligation, or is this a single performance obligation? So which standard is going to get tested here? IFRS 15. So IFRS 15 is a very important standard. So what does it deal under IFRS 15? It mainly deals with revenue. Okay. So we can just quickly revise revenue, because revenue is anyways an important standard for us. So main part of revenue is that 5-step model, right? The main part of revenue is the 5-step model. So how will you explain it? The 5-step model will include first, what is the first step of revenue recognition? That is identify the contract. we need to identify a contract with customer. But it does just simple, it is not as simple as that. Okay. So when you're identifying a contract, we have to identify their fact that whether two parties are committed to the contract. So we need to check the fact that whether two parties are committed to the contract. Then the rights and responsibilities of each parties, that is both the customer and the supplier. Then we need to check whether that contract have a commercial substance. We need to check the fact that whether the contract have a commercial substance. That is, it should be of a profitable element. And then finally, it should be probable that we can collect the consideration. It is probable that we can collect the consideration. So these are the main elements we need to check when we are identifying a contract with the customer. Okay. So it is not as simple as that. So let's say if you are not able to probably collect the consideration from the customer is facing some kind of difficulty. Can you recognize the revenue there? No. Or if it's an exchange of asset, okay, the exchange of asset between two companies. Apart from that, they're not paying any cash in between. So if you feel like that transaction lacks a commercial substance, then we cannot recognize the revenue there. Fine. In the same way, rights and responsibilities of both parties, that is both the supplier and the customer, needs to be explained in the contract. And both parties are committed to the contract. It means that they should not be, it is not like a forceful one. Okay. They have came into the contract with their own full acceptance. So it should not be forced. Okay. It should not be forced. That's what we mean by the fact that two parties are committed to the contract. Is that clear, everyone? That is step number one. So whenever there is a revenue recognition starts, first of all, we have to identify a contract with the customer. The second one is identify separate performance obligation. Identify separate performance obligation. So this is a very important stuff. Even now we have seen that it is getting tested in SPR. Many times they have tested this part. So what does it mean by separate performance obligation? Whenever we are recognizing revenue, we need to identify how many performance obligations are there. Let's say if you are selling a car to a customer, sometimes we used to provide service for free. So how many performance obligations are there? How many performance obligations are there? 2. Why? Because there is a product which is named as car, and in the contract it is mentioned that I will provide the car for the customer. So whatever which is integral part of the car will constitute to be to make it as a car and make it drive for the customer. I will include all such performance obligation into a single performance obligation. For example, we know that car does have a four wheels, and car does have an engine, car does have a seat, and they have a body. So are we considering each of these items as separate performance obligations? Are we considering each of these items inside the car are separate performance obligation? No. Okay, because in the contract it is mentioned that I will give you the car. So what all requires to make it as a car and make it drive for the customer, that will be considered as a single performance obligation, because it is written in the contract that I have to deliver you the car. I know that the car is separately identifiable, the engine is separately identifiable, or what all parts which include that constitutes to be a car, I can separately buy it from the market. Isn't it? But do we consider each of them as separate performance obligation? No. I will consider the car as a single performance obligation, even though it includes the car's the overall body and its wheels, the engine. So like that, there are different performance obligations. do we consider it as separate performance obligations there? No, because I know that I promised the customers to deliver the car. So it is very important that what's written in the contract. So this all elements will constitute together to become it like a useful car. So I will consider it as a single performance obligation. But the service, is it an integral part of the car? The service, is it an integral part of the car? No. The service can be taken from any outside sources as well. It is not mandatory that it should happen along with the car. So it's like a distinct separate performance obligation. So the service that you are giving to customer, even if it's for free, I have to consider it as a separate performance obligation. Is that clear, everyone? So we should always check, is it an integral part? Okay, can they work separately without having any kind of interdependency? This is how we'll identify the fact that are they, does that situation have to separate a performance obligation or does it not? Okay. Let's say you are purchasing an application. Let's say Wink. Have you heard about Wink? Huh? Have you heard about Wink? Huh? You haven't heard about Wink? It's a kind of app. Okay. So let's say you are purchasing Wink. So for purchasing Wink, it costed you $100. So it gives you a 2 years 2 year service. So they are providing you with Wing Music. They are providing us with 2 year service. But we know that there are some regular updates happens, or if you have to be a premium ad-free customer, you have to pay $50 extra. Okay. So in that scenario, is it a two separate performance obligations or it is a single performance obligation? In that scenario, is it a two separate performance obligation or is it a single performance obligation? Single. Why? Updates are integral. Ad free, is it integral? Because even the app can work without these updates and the ad free options, right? I think most of us, including when it comes to Spotify, we are using it without the premium account. But you can still hear the songs, right? Can you reply in the chat? So tell me how many performance obligations are there. So this is how the questions are going to come in SPR. It will be completely based on some practical scenarios. Okay. So you have to make sure, you have to always make sure that like what all things you are getting used to in your day-to-day life. Try to apply this accounting standards there, especially revenue. Revenue can be applied in each and every transactions. Whenever you buy something, you can think about the fact that how they are accounting the revenue there, how many performance obligations are there. That will really help you to improve your knowledge and how to applicate it. Because we don't know that when it comes to your work, in which type of company you're going to work or what kind of client you're going to get in a company after, even if you join for an auditing team. Okay, so we should be very careful that one way of easily applying that knowledge is apply it in your own transactions. That's why I've given this as an example, because I feel like most of you are used to with the music apps. So how many performance obligations are there? How many performance obligations are there, guys? Is it one or two? Just apply your judgment. Is it one or two? Can you hear me? Afla, you said single. Anyone supports two performance obligations? Yeah, actually there are two separate obligations, right? there are two separate performance obligations. Why? Because one is Wink, the basic platform, and updates and other features are not an integral part. Okay, in that way, I can say that it is the two separate performance obligations. But on the other hand, if there is a student who writes the answer as single performance obligation, he may say that the updates are required for the better effectiveness of the app, and the ad-free music feature will make sure that the system will, or that basic platform will work more effectively. Okay, so even we can suggest in such a manner that if you want, you can consider it as a single performance obligation if you are capable enough to justify your answers. Okay, so whenever you get such questions like hardware and software updates or something like that, it will be written in the question. Softwares are not required for the main asset. It can work without the updates. But for the effectiveness, for the better effectiveness of that asset, or if there is a competitor in the market, and in order to be with the market, we have to get updated. Otherwise, the asset will not perform really well. For the better effectiveness, we need the updates. In such a manner, if you are properly able to justify your answer, you can consider it as a single performance obligation as well. Okay, so that's the reason I have given this as an example. So whenever you get such questions, such as software updates, software and updates, or something on the base of these updates, if you want, you can write it as separate performance obligations, no issues. So it is actually a judgment. So this is something wrong with step number 2 as well, or in IFRS 15 itself, because it's up to the judgment of the managers. IFRS 15 says that we have to identify separate performance obligations, but what is identified by Arun will be different from what is identified by Nafla. Okay, so from accountant to accountant, that judgment may vary, but we should be able to justify your judgment. Is that clear, everyone? So don't get panic in the exam in such a manner that, oh, is it 1 or 2? If you are able to justify your answer, if you have a proper reasons for considering it as 1 or 2 performance obligation, the examiner wants to know that, are you able to apply your knowledge there? He is not much cared about the final conclusion. Is that clear? But we should write the answer according to your conclusion. Don't mix it up. The examiner should need the answer that either it is 1 or 2. So your answer should be framed according to your conclusion. But I know that there are students who mix it up. It will be a 1 or 2, like that, they will mix it up. That mix up should not happen. First of all, you should make your mind that either I will go for 2 or 1. Then frame your answers by getting the supporting lines from the answers. Is that clear, everyone? So such freedom is there when it comes to IFRS 15. So make use of it effectively. Okay, I will say that don't get panic. Make it as a choice and make sure that you are probably able to answer it carefully. And once you're done with 2 performance obligation, what is the next one? Determining the transaction price. We need to determine transaction price. So when we are determining the transaction price, again, we need to consider certain factors such as the variable consideration. Then variable consideration means certain customers' revenue will not be recognized at the time of transferring the control, because especially with e-commerce industry, we know that when we are making some sales, there is a return offered. After 10 days, we can return that customer product back to the supplier. Such offers are there nowadays in the market, right? So let's say if I sell 100 products, I'm sure that 80% will not get returned, 20% will get returned. Okay. So in such scenario, so we are sure that 80% won't get returned. Okay. So we are only probable about revenue of 80%. So we should not recognize revenue of 20% because that's a variable consideration. So variable consideration, the knowledge part says that whenever you have confusion with regards to the revenue recognition, in that scenario, we should only recognize revenue of a particular element of which we are that much probable about. Is it clear? So apart from that, another adjustment we need to consider is the financing component. So what do you mean by financing component? Let's say if there is a big timing difference between the transfer of control and the date at which we are actually receiving the money. Let's say I'm selling the product today, I will get the money only after 1.5 years. So in that scenario, there is a major timing difference or a significant timing difference. In that scenario, we have to take the present value of the consideration received. So we need to take the present value of the consideration that you are going to receive in future, and that will be recognized as your revenue. Is that clear, everyone? Can you reply in the chat? Fine. So another adjustment with respect to determining transaction price is the non-cash consideration. Okay, the non-cash consideration. So what do you mean by non-cash consideration, guys? Non-cash consideration means, let's say if you receive shares or any such non-cash item in exchange of a product or service, then the revenue will be recognized according to the fair value of that non-cash consideration. In that scenario, the revenue will be recognized according to the fair value of non-cash consideration. Is that clear, everyone? Suppose if the fair value of that non-cash consideration is not able to determinable, we cannot determine the fair value of that non-cash item received. In that scenario, we'll measure the revenue according to the fair value of the standalone price. Fair value of the standalone price of our product or service that is transferred. So first we will check, are you able to determine the fair value of the consideration received, non-cash consideration received? If not, then we will consider the fair value of the standalone price of a performance obligation. That is either the product or service. Is that clear? Can you reply in the chat? Yes. Anything else to be considered? So variable consideration is covered. Financing component, non-cash consideration. Yes, there is another adjustment that used to come. The cash payable to customer. Okay. So we have to adjust it while determining the transaction price. The cash payable or consideration payable to customer. So how will you identify it? How will you deal with it? The consideration payable to customer, how will you deal with it? Let's say if you have to pay certain consideration to the customers, we have to pay it back to the customer. So what does it mean by paying it back to the customer? Let it be a scenario in such a manner that you have to complete a particular contract by end of this June, end of this year, let's say December 2023. So I'm making a building, and as a supplier, I have given a contract to the customer that I will complete this building by 2023. The overall contract price is 3.5 CR. Okay. And if the contract is not able to be completed because of some issues or delay from my side, I'm ready to pay a penalty of 10 lakhs. I'm ready to pay 10 lakhs to the customer. So this was written in your contract. So by the time it reaches November in such a manner that now you are probable that anyway I'm not going to recognize the revenue of 3.5 because I have to pay a penalty. So obviously there will be a delay. I cannot complete my work by December. So according to the contract, now I'm liable to pay this 10 lakhs to my customer as a penalty. So we cannot recognize revenue of full 3.5 CR. So instead, the standard says that from your transaction price, we have to deduct that consideration payable. So the net amount of revenue that you can recognize will be 3.4 CR. Is that clear? So this is how we'll account for the consideration payable to customer situation. It's not getting accounted as per the standard provision or something like that. So this type of scenario should be dealt in such a manner that the consideration payable to the customer should be deducted from your transaction price. Is that clear, everyone? So these are the main item we have to consider when you are determining your transaction price. Okay. So actually in this question, they are only focusing on step number 2, but I have just revised the other steps as well. So finally, step number 4. What is step number 4? Once you determine the transaction price, this transaction price will be allocated to the separate performance obligation. So like we have discussed earlier, the total transaction price should be allocated to the car and service separately. Even if that service is given for free, we have to recognize the revenue there for the service. So on what basis we'll recognize the revenue? On the basis of the standalone price of that car as well as service in the market. So we'll recognize this revenue on the basis of the standalone price of the car or service in the market. Fine. And what is the final step? Recognize revenue. Final step is recognizing revenue. So we have got two options. That is either at point of time or over the period of time. So how will you make that choice? How will you make that choice? How to recognize revenue at point of time? Based on the transfer of control. It is completely based on transfer of control. How we transfer the control. So if the control is transferred at the point of time, then revenue will be recognized at the point of time. The control is transferred or the performance obligation needs to be satisfied over the period of time, then revenue should be recognized over the period of time. So in this scenario, we know that the car will recognize revenue on the spot itself. And what about service? Will recognize it over the period. Is that clear? Okay, guys. So that's it for the 5-step model. That's the main thing that you will get tested from revenue itself. Okay. So we have just revised that standard as well. So now look into the question and check how many performance obligations are there and whether the revenue should be recognized at the point of time in accordance with the IFRS 15 contract. Now, if it's a single performance obligation, let's say if it's over the period, there is a service included in that scenario. If the service is an integral part of such a manner, in that situation, we have to recognize it as an over the period condition. Okay, if it's a single performance obligation, then we cannot split between point of time and over the period of time. So if there is a service or some kind of software updates, that's an integral part of the main item, then we have to club it together and revenue will be recognized over the period. Okay. So now look into this question. Just read this one. Just read that whole scenario. Just quickly go through the question, guys. JC company provides service to customers to help them evaluate whether there are potential oil reserves in particular geographical location. The customer generally entered into a contract before the survey process commenced and eventually purchased a license to search for oil deposits. So during the service phase, Jersey collects the site data over the first year of the contract, then process and analyze the data over the next 6 months. The area surveyed is determined by JC company and who is the only decision maker and owner of both data and the land being surveyed. All of the data is made available to the customer in the final survey report. and the customer cannot process the data and obtain a license other than by JC's approval, the value to the customer is in the granting of license, not in the data. Okay. So as data is being collected and processed, presentation and reports are given to customers to indicate the potential of an area, and customers have ongoing access to the data during the collection and processing. So when the final report is made available, the customer decides whether to invest in the area. So this is the service phase. Okay, this is the service phase. So when JC is providing service, this is what actually happens. So is that clear, everyone? The service part. Right now, when it comes to granting license, the customer can exit the contract on receipt of the report, but the total price of the contract include the final price. The final license is still payable to Jesse. In practice, no customers leave the contract at this stage because the license is granted at this stage, and once the license has been granted, there is no further analysis of service provided to the customer. The director of Jesse concluded that the company has only one performance obligation, being the granting of a license at the end of the survey. This is because the collection and processing data is a component of granting of the license and cannot be distinguished from the license. In addition, the service phase alone is no benefits on its own. So the final license provided to the customer is based upon the data collected and processed during the service phase. So now the question is, do we need to consider this two phase into two separate performance obligation, that is the service and granting of license, or we have to consider it as a single performance obligation? So what's your call on this question? How will you deal with it? Can you reply in the chat, everyone? So according to the management, they feel like it should be considered single performance obligation, and the service is actually an integral part. So what's your call on this part? I said no, it's always up to your judgment. So just read the question again and try to apply your judgment there. And whatever the conclusion they have come and do, I need the reasons as well. You need to explain me the reasons. Even in the exam, it is required. What about others? Only two of them have replied. What about others, guys? What do you feel? Service alone is of no benefits or single performance obligation. So all of you are supporting the statement of the director itself, because the management already feels the same, right? So is there anything that helps you to identify the fact that there are two performance obligation? Just check in the question. Is there anything? So how you recognize the revenue here? It should be a single performance obligation. Yes, because as it is mentioned that it is a very integral part, and we are not getting any further updated revenue, like any kind of separation between the two. And whatever which is given, even after the service, even once we grant the license, there is no further benefits happening there. Okay. So how will you recognize this? It will recognize as a single performance obligation. And what about, on the other hand, revenue will be recognized at point of time or over the period of time? Because there are two questions, right? First one was like, how many performance obligations are there? Second one was, how will you recognize the revenue at point of time or over the period of time? How will you recognize the revenue there? Is it at the point of time or over the period of time? Can you reply in the chat? Yes, over the period. But is there a service happening after granting of license? Once we grant the license, after that, are we providing any sort of value to the customer? Once the report is available, are we providing any further revenue? No, right? And the customer does not have the right to this particular product during the time of service. It's mentioned that they don't have any rights, right? The only decision maker is JC company. So during that time, the control is with JC company itself. So in a way, once the license is granted, at that point, the control is getting transferred to the customer. From there on, we are not providing any further additional benefits to the customer. Because once the license is granted, there is no further analysis or service provided to the customer. That's what they mentioned today. So is it over the period or at the point of time? Is it over the period or at the point of time? Should be point of time. Is that clear, everyone? Is that clear, guys? So the altogether, these two phases should be put together into a single item, and we should account it as single performance obligation, and revenue will be recognized at that point of time. Is that clear? Can you reply in the chat? Yes. So we'll do the next one. So that is regarding loans to customer and acquisition of assets. So just read that question. Just read the scenario. So this is based on IAS 38 and IFRS 3. Okay. So we'll look into it. First of all, just read the scenario, guys. Just read the whole question. So what is there as an ethical issue when it comes to loans to customer? Do you think that that particular accountant is biased here? Because he is supporting group A, right? Why? Because he is getting a commission on the basis of number of loans getting approved. So even if group A is financially not that much stable, he is giving a biased decision for them. So it will get automatically approved for in the system, because he is having that access to a large pool of data, and that's an issue with this AI systems. Like if we can, since it's a machine, we can make the changes in the machine according to the way we need it. Okay, because he's having that access to that much data and all these factors. So especially in the current accounting world, accounting in the current digital way, there's a higher chance that there is a chance of data leakage and the security of this data. So especially a accountant like this, he should not sell this data. That's another main integral part. And here we have seen that he's making some favor to this particular group of people in order to increase his revenue. So there's a lack of integrity there. So we can mention that part. And there is a deviation from their objectivity. This, as an accountant, what we expect from him, he is not doing the right thing there. So lack of integrity is a threat that we can mention here. Is that clear, everyone? So whenever you write an ethics question, like in the introduction part, we have to say, like as an SSC an accountant or SSC member, we have a objective that we have to follow the code of ethics of SSC and all these factors. And whatever the report that we provide, that should be true and fair. So this is what we can write as a heading. Then we'll mention about this issue. So here, this is the issue, that is, he is manipulating the data. So especially there's a huge data, and if someone who is working like Renshu, the financial account of Renshu company, there is a higher risk. Okay, there is a higher risk that we may lose the data of the customers. Is that clear? Hello. Is that done? So these are two groups. So the ethical issue is lack of integrity. That's what we can mainly identify from the question. And what about the acquisition of asset? What about this acquisition of asset? How will you account for it? How will you account for the acquisition of the asset, guys? So here, is it an asset acquisition or is it like a business combination? Is it an asset acquisition or a business combination? What do you think? Are we purchasing a business or it is just an asset acquisition? Yes, it's an acquisition of assets, because whatever the business which is purchased, which only comprises some database and the number of domain names. So we are actually purchasing two things, two type of intangible assets: the customer database and the domain. So therefore, insurance company has to allocate the purchase price to individual identifiable assets in accordance with IFRS 3. The customer database relates to a contractual agreement whereby Renshu receives a commission for referring the customers to online game website. So Renshu either receives an upfront payment for every customer referred to a gaming website it receives, and a share of revenue stream based on the referred customers further usage. Okay, so whenever we need to recognize an intangible asset, we have to meet those criteria. So I think that database is meeting the criteria because it is probable that we can recognize revenue in future. Is that clear? And what about this domain? Obviously, we have to consider it as a two separate item, but they actually allocate the overall transaction price that you have provided to acquire these two assets on 50-50 basis. Is that a correct way of allocating that total consideration? Can we allocate on a 50-50 basis? No. It's better to allocate it on the base of their fair value. So we should measure the fair value or the standalone price of these two items individually in the market. On the base of that fair value, we have to allocate the overall consideration between the customer database and the domain. That 50-50 basis is not seems to be some fair. Even with IFRS 3, does not seems to be fair to allocate the overall consideration on a 50-50 basis. So better to allocate it on the base of the fair value of that two items, that is the customer base and the domain. Is that clear? So apart from IFRS 15, as you have seen here, IAS 38 is other crucial standard. Even if it's a very small standard or a kind of a very simple standard you have learned from F3, but still it is going to get tested in SPR. Okay, so now read the last part, the payments for the app. So this one is clear, no? The exhibit number 2, is it clear, everyone? How to account for this acquisition of the assets? So we will account it separately because they are two separately identifiable assets. Okay, but the total consideration should not be split on 50-50 basis. We should split it according to the fair value of that two items. Perfect. Can you reply in the chat? Yes. So now read this part. We can just quickly go through it. So Renshu develops a new gaming app in injection with other companies. When acquiring a stake in this project, Renshu makes up an upfront payment and agrees a further payments based on the fulfillment of certain defined objectives in the process, both before and after the app is given for final government approval. Prior to the current year, the payments made have been accounted as an acquisition of separate intangible asset, as the price paid reflected its belief that expected future economic benefits would flow to Renshu. So the probable criteria in IAS 38 is considered to be met. Okay, so in that scenario, can we recognize this as an intangible asset? Yes. However, on 31st December 2008, a revised strategic plan decided that all previously capitalized payment to date were to be derecognized and expensed as a research and development cost. So it's like a reversal of their accounting policy. Okay. So this, as a result, they are feeling like whatever the amount that they have capitalized, they can derecognize it. Is it possible? A similar question is there in the revision kit that is named as Kaiser, which is tested in September 2018. Okay. Basically on IAS 38 itself. A similar question. So what happened here? Initially, they felt like the criteria is met and they are recognizing it as an asset. And later on, then have a confusion with their strategy and they are derecognizing this capitalized amount. So can we derecognize intangible asset as simply as that? Can we derecognize intangible asset or any asset from our books like this? No. We can only derecognize an asset from our books when it is disposed or when we feel like no further future economic benefits are able to generate from this asset. But in this scenario, actually the asset met the criteria. So it means that they have actually met the revenue recognition criteria. They can make the future economic benefit, but there is a change in the strategy. So how will you deal with that such situations? How will you deal with such situations? We will consider it as like an indicator for impairment. Okay, if we have any doubts over the recoverable amount of that intangible asset, then we have to test it for impairment. We cannot just simply derecognize an intangible asset like this. And this should be treated prospectively, retrospectively, because it's a change in accounting policy. Okay, it does not constitute an accounting change in estimate, because if it's a change in estimate, they can simply make the changes prospectively. But here it should be either a case of prior period error. You might have made some error in recognizing it as an asset previously. In that scenario, it's a prior period error, or there is a change in the overall estimate, sorry, overall policy. The policy has been changed. So there are two options. Either we should account it as a prior period error and we'll make the changes retrospectively, not prospectively, or we have to check it for impairment. Is it clear, everyone? But what they have done here, they have accounted it as an accounting estimate. So again, knowledge of IAS 8 applies there. So what is IAS 8? Change in accounting policy, estimate, and prior period error. So if it's a change in estimate, we will make the changes prospectively. That is from the date of change to the future. But if it's a change in accounting policy or if it's a prior period error, in that scenario, we have to make the changes retrospectively. So that's what we have to apply in this scenario. That's the knowledge we have to apply here. Is that clear, everyone? Okay. So IAS 38 is another important standard. So it basically tells with the same scenario have been tested multiple times. The same kind of situations. That is, we are still recognizing an asset. Subsequently, we are derecognizing it, but we cannot do like that. So we have to mention the recognition criteria as well as the derecognition criteria. And the knowledge part is very important for the exam. Perfect. So is it clear, everyone? So just read the next one. Just read the next question. Question number 21. What's the requirement? Discuss the appropriateness of Ravi's accounting treatment of foreign exchange gain or loss for subsidiary which is held for sale. Discuss its ethical issues. And discuss how granting sale of license to Coca-Cola should be accounted for. The accounting treatment of the cost incurred to date in developing the biosimilar drug. So these are the three situations we have to go through here. So just read the scenario, question number 21. Just quickly go through it. Ethical issue here. What's the ethical issue? The ethical issue here is they are recognizing the P and L, the translation gain or loss in P and L. So in case of foreign subsidiary, we know that the translation gain or loss should be initially recognized in which item? As a which item? We have discussed it in the last class, right? When we account for foreign subsidiary, where will you show this gain or loss? The translation gain or loss initially will be recorded in other components of equity or other comprehensive income, right? But here, Mr. Ravi has intentionally included the P&L, included in the P&L in order to overstate their desired results, because even he is at the verge of intimidation threat because he may feel like he may lose the job. The same way, Mr. Malgun is a financial accountant, even his salary is based on the targets. So it's a kind of a intimidation threat happens here. And as a result, what happens? They are misstating the financial statements for their own sake. So we can mention about self-interest threat as well as intimidation threat here. Is that clear, everyone? The ethical issues and the foreign exchange part. So the accounting treatment should be initially will recognize it in OCA and later on reclassification will be done to P&L at the time of disposal of the subsidiary. At the time of disposal of the subsidiary, we can reclassify the gain from OCA to P&L. That is allowed. Is that clear, everyone? Can you reply in the chat? Yes. And what about the sale of license? So when the sale of license, agency granted the sold Coca-Cola license with no end to date to sell headache product head-on in South America. The agency has retained the right to sell the head-on in the rest of the world. The South Americans' relative value is 20%. The manufacturing process used to produce head-on is not specialized, and several other entities could have manufactured it for Coca-Cola. So Coca-Cola will purchase head-on directly from agency at a cost plus 50%. The product has been sold for many years. Coca-Cola made an upfront fee of 15 and will make another 3 million when South American sales exceeds 35. So this 3 million is like a variable amount. This 3 million is like a variable amount. So how much will be the revenue recognized? Sorry, the gain recognized. So it's like a disposal of intangible asset, right? Can we recognize it as revenue? No. When we sell any IAS 38 items, we cannot recognize the proceeds as revenue. But instead, we can recognize the gain or loss in the P&L, like how we normally dispose the asset. Okay. So how will you deal with it? So how will you deal with that situation here? Here we are getting a 15 million as proceeds, and they said that the overall carrying value of that intangible asset is capitalized at 30 million. But we are not making the sales not just to head on. We are making the sales to the rest of the world as well. So this 30 million is just for that particular area. Okay. So they said that the Southern's market relative value compared to the rest of the world is 20%. So the overall carrying value of that particular intangible asset is 30 million, of which they are disposing only that southern part. Right? Only in South America, sale rights is what they are selling. Right? They're only selling the rights related to South America. So we need to determine the carrying value and the sale proceeds. So how much is the sales proceeds here? 15 million will be your sales proceeds. And overall, it is at 30 million. But we know that out of which they are already disposing the South America part. According to their estimate, the South America estimates to be 20% of their total value. The market in South America is 20%, right? So the total capitalized amount of 30 million into 20% will help you to understand the carrying value of the disposed item. We'll get to know the carrying value of the disposed item through that step, and we'll compare it with the proceeds. So how much is the proceeds? 15 million. Can I take the 3 million? No, that's a variable amount. We cannot recognize it right now. We can recognize that in the P&L when that criteria is met. Okay. So for the time being, how much profit will be recognized on this disposal? What will be the profit on disposal? 15 million minus 30 million is the total carrying value, out of which we are only selling 20% of the market. So how much will be a total profit, guys? The profit on disposal? 9 million. Is that clear, everyone? This scenario, is that clear? Okay. So now do this question, the drug development part. So we are just discussing as much as questions we can. So later on you can go through the answers and how to draft it. Okay. So the drug development part. So the biosimilar product for treatment for a particular medical condition. So they are developing it. So development cost, how will you account for the development cost normally? How will you account for the development cost? The research and development, how will you account it? The research phase will be expensed, and development cost, if it meets the criteria, we can capitalize it. So just check it out. Is it meeting those criteria? The biosimilar product is one which is highly similar to another which has already have a regulatory approval. The existing approved product's patent is expiring, and agency has applied to the government for the regulatory approval for new product. The submission includes an analysis which compares suits to agency's proposed product in order to demonstrate their biosimilarity. The government have reviewed the analysis and allowed agency to undertake initial medical trials. Agency feels like trials are going well. The product is used in the treatment of very specific conditions which only affects a specific group of people. And agency has decided to develop the product for the reputational reasons. A person using the product will only pay notional amount for the product if it is proven to be effective. So as of now, do we have any probability that it will create future economic benefit? As of now, is that criteria is met with respect to the recognition of asset? Is that criteria has been met? Check it out. Does the criteria, pirate criteria has been met or not? So at present, we are only focusing on a small group of people, and it will only give you a small notional amount, right? A minimum amount. So that doesn't indicate that the customer, the product has actually having that future economic benefit, or the probability of future economic benefit is not confirmed here. In addition, they are applied for the regular legal approval, but there is a concern over that limited market as well as the revenue stream. Okay, they have actually applied for the regulatory approval for the new product, but we do have a concern because there is only focusing on a particular small pool of niche market, and the revenue stream also we are actually concerned about. Right? So overall, I can say that whatever the expense that we have incurred till now should be expense to the P&L rather than capitalizing it. Is that clear, everyone? Any doubts in that part? So as you have seen that the multiple times IAS 38 is coming into place. So make sure you revise that standard. It's very easy one, but again, those criterias and all points relate to IAS 38. Please make sure that you are reversing it correctly. Okay. Now, just try to do the rest of the questions from that section. Okay. So we have got something like another 4 questions. We have done 4 questions now. So there's another 4 questions. So just do it as homework. So that will be tested from your ethics part. Okay. And now I'm moving on to section B type of questions. So just read this question. Question number 31. So it's a section B type of question. Again, they will test you on some separate standards. Okay. They don't test you on ethics part. So it's completely based on standards. Okay. So just read that question number 31. Arrange IFRS 15 is getting tested in this scenario. So IFRS 15, IAS 38 is getting repeatedly covered in many questions. So you understood that importance of the standards. So when it comes to the consignment arrangement, we know that what is consignment arrangement? We will place the item in the that product or the particular furniture here, the customer, and from there it will that garden center will place it, or the furniture will be placed in garden center, but the garden center will not pay for it. But it will get the revenue will be received when it is ultimately sold to the customer. And Rubel has decided to include the sales revenue of all furnitures delivered to and held by garden centers in revenue. It is appropriate to do so. Is it appropriate to do that? No. Why? We know that we can only recognize revenue when the control has been transferred. Here, at the time of placing these products as a consignment arrangement, it is just a consignment arrangement. The control is still with whom? The control is still with Rubel company. So the revenue can be only recognized when it is finally sold to the end customer. Is that clear, everyone? So we cannot recognize revenue in this scenario. They are simply overstating the revenue. If they are recognizing the sales of all furnitures which is held at garden center, then it's like they are overstating the revenue. That is not appropriate. Okay. Then what about the sale tax situation? Here we have to create a provision because now it is like they felt like they were not paying tax previously, but now there's a higher chance that they will get caught because now the new rules has been came. So we have to adjust it as a provision. So how will you recognize it as a provision? The provision should be estimated or the best estimate of what the penalty and the interest that we have to pay, okay, during these years. And they said that there is very low risk of detecting that risk. The taxation authority will not detect us, but that should not be considered into our judgment, because we know that the rule is there in the country. The country is of the impression that the sales in the overseas countries are subject to sale tax. The company had a physical and economic presence in the country, but without physical presence, still it is liable to pay tax. It is mentioned here. So therefore, the Rubel has realized a liability for sale tax for the previous 10 years. So they literally have liability for previous 10 years because they have been working in that country for 10 years. So it is probable that they will be liable for uncollected taxes, interest, and penalties. So according to IAS 37, we have to create a provision there on the basis of the uncollected sale tax, interest, and the penalties. Is that clear? So instead of 10 years, it is mentioned that they won't look back to more than 7 years. So we have to recognize a provision according to the 7 years liabilities needs to be considered, because it is widely understood that they won't look back before 7 years. So a provision should be recognized anyway. Is that clear, everyone? Fine. So what about this exchange rate? Ruble has substantial deposits in currencies other than functional currencies. So deposit means, is it like a monetary asset or a non-monetary asset? Deposits in currencies means, is it a non-monetary asset or monetary asset? Deposits. Ruble has substantial deposits in currencies other than functional currency. So substantial deposits, is it a non-monetary asset or monetary asset? Can you reply in the chat? Yes, it's a monetary asset. Then according to IAS 21, if there is any kind of exchange rate loss or gain on monetary asset, where will you recognize it? In P&L or in OCA? For monetary asset, will be recognizing in the P&L. Okay. So these countries often suffers fluctuations in the exchange rate. So Rebel company decided to eliminate the effects of exchange rates differences and presented the financial information using historic fixed rates for the translation of international subsidies, which is not updated between the periods. So here we have to mention that it's very important that we have to recognize that gain or loss according to the latest changes in the exchange rates itself, not on the base of the historical fixed exchange rate. The translation should happen on the base of the up-to-date date because it's a monetary asset. So at the time of settling this monetary asset, what its released value, we should convert those amounts at the latest exchange rate, not according to the historic rate. Historic rate will be used for non-monetary assets. Okay. And that gain should be recognized in P&L. So that's what your suggestion should be. Is that clear? So this is, we can mention that whether this is acceptable. No, it cannot be acceptable. And enhance the usefulness of the financial statement if the gain or loss deposit were recognized in OCA. So literally we know that if it's a monetary asset, the revenue should be recognized in P&L. But because of their continuous fluctuations, we can say that it may be appropriate to show it under OCA and later on we can reclassify to P&L. So that's a suggestion we can give because the exchange rate is getting fluctuating on a very volatile manner as they have mentioned here. It is very volatile currently in the market, the exchange rates. So if you want, according to the principle, not as per the standard, according to the conceptual framework, we can give a recommendation like, since there's a volatility in the exchange rates, it's better to show it under OCA for the time being. And later on, we can reclassify to PN. So that's a suggestion we can give because that will give more reliable information to the users. Fine. Otherwise, this gain or loss will get repeatedly changed. So for the better presentation, you may recognize it in under OCA initially, and later on we can reclassify to PN. So that's a suggestion we can give. That's completely a discussion part. Is that clear, everyone? Okay. So climate changes is the next question. So one thing you have to understand is that is actually a part of your current issue as well. So whenever there is a climate change, okay, climate change, there are many other accounting standards are getting affected by it. So what all are the normal accounting standards that will get affected by climate changes? We have to learn that this is a general topic because it is one of the crucial part in the day-to-day world, the climate changes. So one thing it is IAS 36. Because of the climate changes, we know that many assets will get impaired. Many industries will not have a better sale, especially like agriculture and all these factors. So IAS impairment is a very important standard we have to focus on. The impairment and IFRS 9, that is impairment of financial assets, because many banks will not be able to recover their loan during these periods. Okay, during the period of this pandemic, there's a higher chance that the bank won't be able to release their money back. Okay, so we have to consider it's like an impairment of both the assets as well as the financial assets, physical assets as well as the financial assets. So we can mention about the standards. And the product value will go down. So we have to mention about IAS 2. Okay, the inventory value may change. So there will be changes in the NRV. We have to consider that. Then sometimes we may have to pay some penalties of not meeting the environmental criteria. So government will introduce some new environmental laws. Obviously, we may breach them. So we have to mention IAS 37 in case if you have to pay any penalty. Okay. And if there is a higher threat that the company is having some going concern issue, then we have to commit under, that will come under IAS 1, that is going concern issues needs to be mentioned. So in such a manner, many other standards relating to climate changes needs to be addressed. These are some of the main issues that we have to address. That is impairment, then impairment of IAS 2, then provision part, as well as the going concerns. So this is a very general topic. So that's the reason the examiner have given a sample paper on the same. So even if you look into this question, you will get the impact of similar standards that we have discussed right now. Okay. So they have asked the impact of IAS 16, IAS 36, and IAS 37. Okay. So just read it. Just read that climate changes issues. Just read that question. Okay, so here there is a climate change issues, and Juan company have several coal-fired power plant as well as currently facing challenges dealing with the impact of climate changes. So Johan has not considered the effect of climate changes when preparing the current financial statements, but there has been a decline in the demand for energy from Johan's coal-fired plants, and because of the volume of greenhouse gases emitted by the plants. The company is committed to meeting the expanding climate changing regulations for its jurisdictions relating to emissions. So if the company does not meet such jurisdictions regarding to the climate change targets, then fines are imposed by the government for this failure. So there is a chance that which standard will get impacted according to this scenario. Out of these three, which standard is going to get impacted here? Fines. They are mentioning about fine. So which standard we have to mention there? If there is a concern that if we are violating the rules, we may have to pay the fines. So in that scenario, it's probable that we may have to pay fine in future. So which standard will get affected here? We have to mention about IAS 37. Yes, very good. We have to mention about IAS 37, provision, contingent liabilities, and contingent assets. The next one, as a result, Juvan has changed and adapted its business activities and operations, and including increased expenditures on research and development. The company has revised its assumptions about future profitability and cash flows based on cutting its emissions. And if does not cut emissions, it will risk losing many customers. So, which is under threat here? Yeah, we can mention about going concern, and there is a chance that we lose the revenue. So that's another indicator that the whole company's revenue is going to lose. So IAS1 going concern issues are there. Apart from that, our impairment will happen because we are not getting the cash flows as we expected, right? So there's a chance for impairment as well. We can mention this point under the impairment part. The company's supply chains are becoming more complex and globally spread with many points of possible failure. So Juvan has subsidiaries in regions of the world which are subject to weather streams and anticipate some physical harm to PPE because of this. And this is the likelihood that some of the power plants will require decommissioning sooner than expected will mean restoring the land damage. So again, decommissioning cost, which standard is going to come here? Decommissioning cost. Provision. There should be a provision for this decommission. Okay. And the corporate risk is increasing due to the environmental damage caused by the climate change. So investors are worried about their share value in Juvan company because of the anticipated increase in the carbon taxes and significant costs which the company will have to incur if it's made its commitment. So what does it mean by it? The value of share will fall down. So again, that's an indicator that the market value of the company will fall down, and it will directly indicating with your impairment scenario. And obviously, with respect to IAS 16, we have to re-estimate the useful life of the asset as well as we have to re-estimate the residual value of the asset. So these are the impacts on IAS 16. Is that clear, everyone? So this is a very generic question, but very relevant according to our current scenario. Fine. And we have to discuss about the validity of the above views expressed by the preparers of financial statements regarding materiality. So we know that according to any FS, if it is as of now, we cannot see any impact of climate changes in our FS, even for Juvan company, right? But still, it is required to give some additional disclosures to the users because it may have a determinant effects of the climate changes in future with respect to these standards. So even though the item is not material right now, but it is very important to discuss about this climate changes issues in your additional disclosures because that will be more beneficial for your investors. Okay, so it is not as material because materiality means omission or misstatement or something that will affect the economic decision of the user. That's what I mean by materiality. So it is not directly affecting any balances in the FS or any sort of carrying values in the FS right now. But as a accountant, we have to be very much faithfully representing our FS. So it's better to give some additional disclosures based on this climate changes. Okay, even though it is not material right now, it may be material in future. So it may have a huge impact on our efforts in future. So we have to express our view. That's what they are mentioning here. So as a preparer, even though it is not required right now, we have to give some extra through our other reports such as management commentary or through the sustainability reporting. We can mention about these climate issues through our other reports apart from FS. Okay, so even though the standard does not specifically requires you to disclose it, it may be as an ethical duty we have to do that from the part of our ethical side. As a part of ACCA, like being a professional body, we have to mention it to the users. Is that clear, everyone? So you got an idea that how each standards will get tested in section B. Okay, guys. So I will keep one more sections. Okay, I will keep one more section and we'll cover another question, some more questions because there is around 20 questions from section B. Okay, in the latest kit, I think till question number 50. So now we are done 32. Till question number 50, it is testing section B. So I will discuss other questions as well. So I will keep another more section. Okay, I will update the timing in the group. So meanwhile, make sure that you can practice rest of the questions from question section A regarding ethics. I hope you have done groups. Okay, but group is already covered. So make sure that you cover ethics part because almost 4 questions I have done from my side. Another 4 questions is left. Okay, so in the same way from section B, now we have done 2. Again, there's another 18 questions. I will cover it. I will try to cover the maximum questions in the next section. Along with that, we will discuss about the current issues there. Is that clear, everyone? Okay, thank you, guys. We'll see you on the next section. This classes will be updated in the YouTube. Very soon it will get updated in the YouTube.